Hey everybody, welcome back into Mining Stock Daily this Monday afternoon. Going to kick off the corporate updates with the week with one from Minera Alamos and President Mr. Doug Ramshaw. Minera Alamos trades on the Venture Exchange with MAI. And finally, after a long-awaited announcement, we were waiting for this announcement for the financing package from Cerro de Oro and that gold project that's coming in due time. Next in line after Santana. And we now know who that funding partner is, a company that's fairly well known in the precious metals space. And so, Doug, first of all, congratulations. I know a lot of your shareholders were, like myself, were bugging you and bugging you and bugging you for weeks about this, but at least it's out there. So give us a rundown of what we have. What do you got to work with?
Yeah, I think the lawyers just decided there was nothing else they could bill for. So we finally got it over the line. But yeah, I mean, it had been a painful 3 months of legal drafting, and there was never any doubt that we were going to do it. In fact, I'm even more pleased with the terms we were able to line up with Ormet back in May for the project. And yeah, we're committing to this because we feel very comfortable about the permitting outlook for Cerro de Oro in Mexico. So it's a big step in kind of validation of the project. We're extremely happy to be working with Ormet, who we've had a close working relationship for quite some time now, both in this company and predecessor companies. So going back to Castle Gold, I believe. So yeah, no, they're a very flexible, supportive partner, and so we're very happy to have them involved with our plans for Cerro de Oro.
All right. So it's $25 million US. That's the complete package. It's broken down into kind of two identities. There is a $15 million loan facility. Five of that you mentioned in the news release that you have already drawn down, and then there's a $10 million royalty package to bring that total up to 25. So let's talk about the loan facility first. Doug, you had mentioned in previous conversations here with me on the podcast that you were looking for debt because the cost to build Cerro de Oro, the capex currently is not that high compared to a lot of late stage developers in the gold space. We knew that. That's what your bread and butter at Minera Alamos has always been. So with this debt here, we'll give us the terms of that, and then why the drawdown of the $5 million right away.
Sure. Yeah, I finally can't wear the we're debt free as some kind of badge of honor, and that was always the plan. We said years back. The purpose of building Santana first was we had no problems taking debt on to build project number two. So it's $15 million, 3-year term. It's basically 15% money. And we were prepared to pay a little higher in terms of a cost of capital to have the flexibility, the covenant light type money here, especially when you consider that the payback on Cerro de Oro is less than a year. So we drew 5 of it down immediately because the goal was always, and something we looked for in all the packages we were negotiating, there's some pre-permitting work that we want to be doing at Santana. Long lead order items, pad liner and the like, where we want to be able to put deposits down on them to ensure, availability when we need them. Potentially even starting the fabrication of the larger than Santana carbon plant that we fabricate in Mexico. So just to have that flexibility whilst and not constrain the cash that we have on the balance sheet right now to be focusing that on Santana and other activities in the group. So quite comfortable withdrawing this initial 5 down. The remaining 10 of the debt and the $10 million royalty facility, they're both drawable upon receipt of the main construction permit from the government. So sometime next year, we'll draw the other 20, get it built. It's a quick roughly 6-month type build at Cerro de Oro, and also quickly pay that debt back, because I think at $1,600 gold, which our model was done at, it had about a 1 year payback if gold's still at $1,800, $1,900, a little bit more gravy, a little quicker payback. And it's not just that it's a low capex project, Trevor. I mean, it's low operating cost as well when you consider the current sector trend in all-in sustaining costs. This project ticks off both low operating costs and this our kind of remarkably low capital intensity that we, as you say, is our bread and butter. It's our signature, really.
Yeah. Can you break down the royalty clause here? And, anytime a gold company sells a gold royalty from their project, there are going to be people out there, well, you're giving away the bread and butter, some of the bread and butter of the project. And so I'm sure you've had to answer that a little bit today. How do you answer those questions?
Well, today's news was certainly, I mean, it's reassuring for our shareholders. I always said there was no material changes in the business terms from May, and it was going to get done. It was just legal beagles at work. I was cognizant. Some people don't like royalties. Some people understand royalties and the value at certain times of a sector cycle where royalty money is actually advantageous to get. And clearly there are enough royalty companies out there, and seemingly new ones created every few months, that there's an industry that is, supports royalty companies and royalty companies that support the industry. So that being said, we ensured that the royalty package that we did, and because Auramet are not a traditional royalty partner, they were more flexible in this than if we'd done this with a traditional royalty company. And there is a big buyback on that. So the 10 million US royalty is for a 2.75% NSR. We can buy 2% of that back for 6.3 million US. And for every month that's outstanding from the point of drawdown on that royalty, 100 ounces of gold need to be delivered against it. So there's an incentive to early restructuring, buying it back, refinancing that if need be. But it means that the residual royalty on the project, for those people that hate royalties, it would only be 0.75%. And there's barely a claim in Canada that doesn't have some legacy royalty of 0.5% or more.
Right.
Auramet actually retained the right to put that last 0.75 back to us for 3.7 million US. So theoretically, the long-term encumbrance on the project is anywhere between 0 and 0.75%. So for those that don't like royalties, and I understand why they don't like them, but this is actually probably more favorable than most royalty packages you'll see out there. The other thing that we wanted to ensure with the buyback, and what we are permitting right now, is a much larger operation than it was shown in the PEA. We've talked about it before. It's probably the management upside case is, not the 8 years at 60,000 ounces a year that was in the PEA, but more like 11 to 12 years of 85, 90,000 ounces a year, some years peaking over 100,000 ounces. But you can only price a royalty on the existing ounces there. So another reason why, when we have a clear understanding of how this resource will get bigger, and we're permitting because of that, how clear that understanding is, we wanted to ensure that we weren't pricing a royalty on all those future ounces, but based on today's ounces. And so I think it was a very smart package with a very good partner that's very supportive, and we definitely look forward to building Cerro de Oro in 2024 and demonstrating this kind of multi-mine sequencing of our operations.
Okay. For anybody who's curious or maybe have forgotten, the PEA for Cerro de Oro came out with an after-tax IRR of 111%, after-tax NPV of over $150 million. Payback is 11 months here. And this was using a $1,600 gold price in that technical report. And we all know we are much higher gold price now than when that report was published, much more higher than the $1,600 base case here. You can get this thing, paid down there pretty dang quickly. What does the economics look like for Cerro de Oro at current gold prices, Doug?
Well, I mean, it's interesting because the life of mine ASIC is 873 in that project,
Right.
and based on $1,600 gold. I mean, in reality, if gold was 1,900 or $2,000 an ounce, you're going to drop your cutoff. You're going to produce more ounces at slightly higher ASIC and play the delta on the cash flow there. So, it's going to be a sub-1,000, type operation even in these gold markets, which gives you, 800 plus 900 dollars an ounce cash margin on 60, 70,000 ounces a year. That's a tremendous amount of both operating cash flow and free cash generation. So, but, rather than looking, our business model was always designed to work in bad gold markets. I think at
Hmm.
1250 or 13, I think I ran it at $1,300 gold, it's still got a 41% IRR. I think that's actually more telling than what the upside is. I mean, there's
Sure.
lots of high cost producers out there. Gold moves up. Everyone's going to make some money. I think what's more important is building a model which is defensible in a lower gold price environment. And certainly projects like this can take advantage of higher gold prices. And certainly when you're not spending years repaying a whole ton of debt, it means that cash generated really can go into reinvesting in the business, not repaying debt for years on end.
The pre-production capital for Cerro de Oro is about $28 million. And so you've got 25 of that, covered in this financing package. I assume the last three or whatever at the end, the end price tag comes at will be covered through, revenue coming out of Santana and through the company's current production profile. But last week we had a long conversation with Koala Doug, and we talked about CapEx overruns, just kind of honestly being the name of the game in mine development anymore. And it's just, we shouldn't be surprised when that happens, but, give us a sense of kind of how you are approaching CapEx overruns with Cerro de Oro. I mean, $28 million is a lot different than, $2 billion. Let's, obviously, but what are the concerns for inflation in building Cerro de Oro when the price tag comes?
The inflation rate in Mexico is about 5% right now, and it's not like things are crazy down there. It's worth pointing out that 28 includes 30% contingency. So realistically, this package covered the base CapEx 22.8 plus 10% contingency on that. Anything above that should be satisfied by Santana. But we're not anticipating it. And I think the big difference here is Cerro de Oro, if there was a 20% cost overrun, it's $5 or $6 million. To put in perspective with those kinds of larger gold development projects that have seen major capex overruns, these $200, $300, $400 million projects and up, we can build 5 Cerro de Oros for the cost overrun of those projects, not the capex, just their overrun on it. And so, it's not that we want to be flippant about, we are very insulated with these low capex builds from this inflationary environment. It's unlikely we're going to run into the problems of big projects, and it's no fault of those companies. I mean, the reality is, for a lot of projects, you start a process that's many, many years in the development and construction of these assets. And if you're just unfortunate with timing, with this big inflationary event that we've had, it can lead to big cost overruns, which have been met by large dilutive equity to bridge that funding gap. And it's no fault of the company. I mean, there are other companies, sometimes you just build and you're in the wrong part of the gold cycle. That's the nature of this cyclical business, but it's also one that, we're very cognizant of building projects to try to break away from that cycle. Projects that work in good times and bad. I think we have an industry where, unfortunately, and you see it with the performance of gold equities just versus the gold price. You better, if you want gold exposure, just own gold, because gold equities tend to amplify these cyclical problems of the space. And so one of the big things we're trying to do at Minera is break from that convention, is break away from the cyclical nature of this sector, which has unfortunately been quite sickly for mining equity shareholders. And I mean, we're not any different than that. Our stock has really tracked the broader money flows in this space. If you use, say, the GDXJ as a proxy for the last 5-6 months. But I think our business model is one where, as we develop these mines, we should prove to be counter-cyclical to those broader money inflows. And I think that's the job I have to do of encouraging people to look at Minera differently than a typical gold producer. We aren't your typical gold producer in many aspects, but I think it's one that should be able to do very well in good markets and bad. And I think it's important to highlight that, you have to have a business model that can work in whatever environment. I think it's going to be pretty a positive gold environment in 2024. But eyes wide open, we've got to make decisions if that's not the case, that we can still perform very adequately in whatever market we've got facing us.
Yeah, absolutely. All right, Doug, I appreciate your time. Again, congratulations on finally getting this over the line and getting the lawyers to sign off on it. I know it was some time coming. We'll be catching up again later this fall, I believe. So enjoy yourself until then, and best of luck and stay safe down there.
Thanks, Trevor.